Yeah, shall I start?
Yes, please. You're live.
Good evening, respected dignitaries, esteemed speakers, and fellow participants. I am C. Amita Vissa, your moderator for today's session on the topic FEMA and FCRA intricacies and compliances. On behalf of the Committee on Commercial Law, Economic Advisories, and NPO Cooperatives of ICAI, I warmly welcome you to the Day 4 of Knowledge Express Week. This week-long series is designed to deliver practical insight across crucial domains relevant to chartered accountants. We have already covered succession planning, arbitration, and anti-money laundering, and today's focus is on area and that is both dynamic and highly impactful, that is FEMA and FCRA intricacies and compliances. Today's discussion brings together leading experts to unravel key regulatory aspects, common challenges, and best practices associated with FEMA and FCRA compliances. Now, let me introduce CA Arpit Kabrasal. His pursuit of entrepreneurship's excellence began in 2016. A qualified chartered accountant and company secretary, he has been the chairman of Western India Regional Council for the year 22, 23, 24, and secretary for the year 21, 22. He is currently Central Council member of ICAI for the year 2025 to 2029. Over to you, sir.
Thank you, Amitaji, and good evening, everyone. What a wonderful occasion. We are about to enter into the festive season of Diwali, and happiness everywhere, lights everywhere. So I'm sure here's wishing you an entire year full of lights and happiness in your life. Today, I must congratulate the the Committee on Commercial Laws of thinking out a topic on FEMA and FCRA. I think it's one of those topics. For most of them, both of these sounds like passwords. They could be some FCRA or FEMA and whatnot. But yes, it has got some super significance in the way our country operates, in the way our social fabric actually works. So today, let me first also welcome Kusai Gowala ji. I think one of those people who many chartered accountants look up to as a teacher, as a mentor, and as a thorough professional. I think with him we always got some superb insights. Thanks, Amita ji, for setting this up. And Abhishek, I think, who's the next speaker. Welcoming all of you. Friends, today, as I said, if you think about, these two laws are like the twin guardians of India's financial borders, and they are not to just regulate money, they regulate the intention. They ask one simple question: where is this money coming from and what is it really doing here? Nothing else, nothing fancy, nothing very, very typical about it, no interpretation and all of this, but simple. What is the source and why is it here? And every NGO, every investor, every auditor, and more importantly now, our role has become superb in both of these frameworks. If I were to give you a simple statistics, 20,700 NGOs, their licenses were cancelled by FCRA since 1976. That till date, I'm saying, so many registrations have been cancelled. So therefore, not just statistics, but it is, if I were to tell you, all of these were actually created to do some noble work. FCRA registration, matlab, they will get foreign funds and they'll put it in for a good purpose, and NGOs have. But they lost it due to paperwork, poor governance, and procedural neglect. I think in this phase, it is we chartered accountants who need to really contribute a lot and help these NGOs actually survive. The Ministry of Home Affairs last year have cancelled 5 major NGOs. Their registrations were cancelled. They have, all of them were social service arms of different organizations, health, religion, and all of this. The reason was misuse of funds, non-reporting, or receiving money for one person, spending it for another. So FCRA in short means do good, but do it transparently. And the FEMA, of course, all of you know, foreign exchange reserves. And today it is so very important with Donald Trump doing his theatrics in different manner. But with so many power plays happening along the country, along the nation, silver, gold having a significance again. Um, FEMA deals with foreign exchange. But when NGO receives foreign shares or trust gets a donation that looks suspicious, like an investment, well, that is where FCR and FEMA will collide. Now, in this space is where Kusai sir and Abhishek ji will set up a context for us, and I foresee a huge opportunity in FCRA with the kind of actions that this government is now taking, and with the kind of intention that this government wants to bring, the discipline that this government wants to bring, I think we all have a very sharp role cut out in terms of getting these and with PMLA also making us reporting entity under the PMLA. I think our role is now solidified. With these words, I'm sure you'll have a wonderful session. I would request all of you to, instead of just listening to this session, please make notes. While Kusai sir mentions and he shares things, please keep making notes, because that is how you will be able to recollect or remember or maybe connect again, and ask questions whenever you feel like, so that he can actually answer it much more better, because the more you'll ask, the more he'll be able to refine his thoughts. Otherwise, we have to keep strictly in those four corners only we'll be able to. I think with these words, thank you very much, Kusai sir, for taking out time for all of us. And I'm sure the audience will have a wonderful session and will have a great learnings on this. For any help, any assistance, as a Central Council member, I'm handling Digital Accounting Assurance Board and the Startup MSME committees. Feel free to reach out to us for any help that you may need. And FCRA, I'm sure it's the way to go now in the next future. Over to you, Amita.
Thank you, sir, for this wonderful insight. It's my pleasure to introduce our distinguished speaker for today's session, C. Kusai Guawala, a fellow member of the Institute of Chartered Accountants of India with an illustrious career spanning over 37 years. He's a partner at Messrs. GKDJ and Associates and has been a guiding force in the profession through his deep expertise and active contribution. He has served on India's implementation committee of WIRC of ICI for 3 years and was also nominated to the research committee of WIRC, reflecting the commitment to thought leadership and technical guidance. A prolific speaker, he has delivered lectures across India on wide spectrum of topics, including tax audit, IFRS, Indian standards, ICDs, company law, GST, at seminars organized by ICAI, ICSI, and CMA. His contribution extends beyond the podium. He has been part of the expert groups that authored and reviewed several key ICI publications, such as the Guidance Note on Internal Audit of Automobile Industries, and has played a pivotal role in compiling reference works. There are various reference works, and his workings are there with institutes, including peer review manuals. His dedication to professional development and his ability to simplify complex regulatory frameworks make him an invaluable resource for practitioners and students alike. Please join me in welcoming C.A. Kusai Guawala. We are honored to have him with us today. Please welcome, sir. Over to you for the session.
Thank you, Amita ji, for your kind words. My friend and the Central Council member, RPG, thank you for your starting remarks and kind of support that you have given us earlier also. And your hard work in the institute is always very much acclaimed. Now, yes, my dear professional colleagues, a very good evening to all of you. I must first thank the Committee on Commercial Laws, particularly the Chairman Abhay Chajarji, for giving me this opportunity. The people who are behind the scenes, the Mayank ji and Anjali ji, who have been, getting this act together and putting in a lot of efforts. I must compliment them for these efforts which they have put in. So today we are going to discuss a very interesting topic on FEMA and FCRA. As already RPG has given a little background as to what is this FCRA. A lot of things have happened in FCRA, a lot of cancellations have happened in FCRA. FEMA, how important it is. I am going to share with you in the next 2 hours an insight into various intricacies and compliances of FERA and FCRA, so that we as the members of the profession should be equipped with those kind of things. Now, let me give you one simple example as to, first of all, why FEMA and FCRA are so important in our daily practice. There are people who are only, doing standard practice like audit or, income tax or GST, and they are not handling FEMA. Today, there are very limited FEMA professionals who are handling all over India FEMA and FCRA work. But if you are even handling standard audit and other work also, which is normal practice areas, FEMA does come into play. Even as a statutory auditor, even as a normal advisor to your client, it definitely comes into play. And I'll give a simple example. I mean, I'm sure many of our members here have got clients who have got exports. And the moment they have exports, FEMA is applicable. They are required as per law under FEMA to realize their debtors, sundry debtors, whatever export sales they have done within 9 months of their export invoice. That means if they don't realize this, then there is a non-compliance of FEMA. Of course, there is an extension provision, all that is there. But if there is a delay in receiving those things, and as a statutory auditor, it is our duty bound to even report and put that in our audit report, because that is a non-compliance of a law and that is material impact. There are other aspects. There are so many other aspects, like for example, liability to be paid for an import. There is again a regulation that says that within 1 year, you are supposed to pay this liability. You cannot extend beyond 1 year. If you have to extend beyond 1 year, you have to go to the RBI and take approval. So it's a very difficult process, and RBI does not encourage this delay. The reason why? Now see, if you people who have heard me know that I always go to the concept level as to the question is why. For each and every aspect, why this particular provision has been introduced. So once I explain you that concept, you will never forget for life. So that is the objective of today's session, that we make it so simple and easy for you to understand that you will never forget this entire thing for life. So as far as the money, but why about the payment? Because India has an image India has got an image in the international market, and if tomorrow if there is a delay on the payment by a supplier, it will not impact only the supplier's image, but it will impact a country's image. Today we all are aware that there are so many countries, I will not name them, where somebody who is doing business with those countries, they expect 100% advance payment before they even dispatch the material. Or even if there is an LC, they want an LC to be confirmed by a European bank or other bank, foreign bank. They don't want that country to bank to even give an LC. So even that is a level of credibility of those kind of countries. India doesn't want to be in that league. So we want our credibility to be at the highest level, where we are in a position to honor all our commitments, and that is what the government wants, and that is what provision is there. So if there is a delay in the import payments also beyond 1 year, yes, it is a non-compliance of law and requires the reporting under statutory audits. So as a statutory auditor also, we have a role to play in terms of compliance with other laws, other than Companies Act, other than the accounting standard, auditing standard. We are also required to see that the other laws have been complied with, and FEMA is one of the very important sections. Let me give you one more example. People who are into software exports, even ITES, they are into ITES exports. They are compulsorily required to register with STPI, and before they send an invoice to the customer, that invoice has to go to the STPI. They will vet the invoice first. After they approve the invoice, but the rate part, they want to know whether the rate what is charged is as per the market rate or as per the arm's length price, and then only they will approve the bill, and then the invoice can be sent to the customer. So this is a process, and I've taken several lectures on FEMA, on the certification course and other courses, where when I was talking to the audience, people said that, oh, we didn't know this. We have got so many clients who are into exports of software or ITS, and they have never registered with the STPI. So this is a total non-compliance with the FEMA laws. So this is something which we all as a chartered accountant should know, that what are the compliances required under this FEMA and FCRA, and definitely guide our clients. So today's our agenda is first to introduce you to the FEMA as to what is FEMA. Then what are the opportunities that is available to our chartered accountants and the practicing chartered accountants. Important definitions under the FEMA. Then there are deposit accounts. How do you deal with it? And I've got a beautiful formula or explanation on how the deposits have to be identified, or what are the do's and don'ts of deposits. I'll share with you when we go to that slide. Inbound investments, non-debt rules. This is when the foreign investment is coming into India. This is where what care has to be taken, how the compliance have to be done. That is what I'm going to explain you. Then there is an outbound investment. What is outbound investment? Many of the Indian entities want to set up a company outside India, want to set up a subsidiary outside India, want to have investments outside India, want to set up projects outside India. So how do you do that? Well, set up a branch office outside India. All that is covered under the outbound investments. Then there are other compliances like LRS, remittances, exports. You must be aware that as a resident of this country, resident in India, you can remit up to $250,000 per financial year per person. That means, suppose if you have a family of 4, you can remit up to $1 million every year with $250,000 each, to buy properties outside India, to buy shares outside India, to have an account outside India. All this is possible under FEMA. Okay. Similarly, money can come into your India for getting shares of your company. You can have a partner who is sitting outside India and become partner. Now even LLP has been opened up. Earlier LLPs were not allowed to have any non-resident investments. Now even LLP can get non-resident investments. I will explain you what are the compliances. Then we are going to discuss FCRA law and the compliances, because FCRA is not part of FEMA as such, but definitely it is a very important provisions, and non-compliances are very, very serious. So now, just before we go into it, let me give you a little background about how this. See, earlier, before 99, there was a section, FERA, provisions for FERA, for Foreign Exchange Regulation Act. And it started from the independent day. FERA was introduced in 73. There was an amendment. There was a rehaul of the entire section. FERA was rehauled, but again, it was then simplified to FEMA. FERA was a draconian provision. The sections were very, very strict. You couldn't do anything. You couldn't even buy any foreign exchange. If you had to buy any foreign exchange, you had to require permission. Even had to go to foreign travel, there was a quota. You cannot take so much of exchange. Now it is so freely available. I mean, you cannot have an investment in India. You cannot have investment outside India. All this were restricted and all subject to approval, and this was very time-consuming and difficult, so nobody used to do it. And when it came to FEMA, India realized that why FEMA was introduced, because India realized that when there was a FERA, India did not have sufficient foreign exchange. For example, when in 1991, India was totally in a collapse position as far as the foreign exchange was concerned, because it has to pay for the oil, and they didn't have any single foreign exchange to pay for subsequent months' oil bill. So they had to literally, send 20 tons of gold to Switzerland by ship, and they raised only $200 million out of that. And later on in July 91, they shipped around 47 tons of gold to Bank of England to get another about 405 million. Now, see, we are talking about millions. And you will be surprised to know that today our foreign exchange reserves are standing at almost at $675 billion. You can see what is the difference. Now, the difference is only because of the FEMA. Because FEMA has opened up the entire economy, because India is now can bring the money. I mean, anybody can bring the money into India. A foreign investor can invest into India. Foreign investor can exit and take the money out of the India. One can invest outside India by setting up a company, as I mentioned to you. So all that is now do as per whatever is given under the guidelines, and you don't require any approvals. So it is all basically it is under automatic route and not under any approval route. As under FERA, it was everything was under approval route. You could not do a single thing, and approvals were very difficult to get. But here they have liberalized everything and said you can do everything. I will share with you what kind of automatic route you can do without even going to any bank or without any RBI approval. You can do certain transactions. So it is now become very, very easy. So this is what basically FEMA has been replaced by FERA. FEMA was replaced. FEMA replaced FERA in 1999. And it deals with those transactions between person resident outside India and person resident in India. If there are transactions between person resident in India and person resident in India, FEMA doesn't come into play. If there is a transaction resident, between person resident outside India and person resident outside India, FEMA is not into picture. So FEMA comes into play only when there are a person who is outside India is dealing with a person resident in India or other way around. Then there are different kinds of transactions, current and capital account transactions. We, as an accountant, generally think that capital account transactions means are basically assets, fixed assets. No, it is not that way. Current account does not have any fixed asset. The current account does not have any, it's only raw materials. No, it is not that. We have to come out of that accounting background, and we have to now look at FEMA. FEMA current account, for example, somebody who is importing machinery for his own factory. An import of items, so it is a current account transaction. So there are, I will share with you what is the difference between capital account and current account. India today is fully convertible on current account. Now, when I say fully convertible on current account means you can do a current account transactions freely without any restrictions. Okay, like for example, when you have to travel outside India, you don't need any approval. You can just go to the bank, draw the exchange, whatever you need. The bank only will see or take a copy of your passport, see the visa copy and the ticket, and they will release whatever amount of dollars or whatever currency you need for your foreign travel. It will release, and there is no restrictions on that. Whereas capital account, yes, there are conditions, there are certain compliances to be done. That is what capital account transaction. We are not fully convertible on capital account. Of course, it is under automatic route. But still, compliances are compliances are there. Like you have to file some forms, Form FCGPR or Form ODI or whatever. We have to file those forms when we are doing those kind of capital account transactions. And as I said to you, told you, it is automatic and approval routes. There now under FEMA, the act is very, very simple. It has got only 49 sections. Simple, 49 sections. Income Tax Act has got so many sections. We are expert in income tax. And GST also, we are so expert. Before we go into it, let me share with you one very interesting thing. If you think that we can handle income tax so well and we can handle GST so well, the complexity, if you compare complexity of income tax, GST and FEMA, income tax and GST, if your complexity wise, if it is at the scale of 10, FEMA will rate at around 4 to 5. So it is comparatively much more simpler than income tax. There are hardly any ambiguities. There are some ambiguities. I'm not saying totally it is free from ambiguity. There are some ifs and buts, but generally it is very clear and transparent. There is clear-cut procedure laid down. Okay, if you want to do this, you have to follow this particular process, and if you follow that process, then you are in compliant mode. You are not non-compliant. But if you don't follow that process correctly, even if you miss out one aspect, then you are a non-compliant as far as FEMA is concerned. I will share with you how it works. Now, as far as FEMA is concerned, the act basically says that you can't do anything. Okay, that's how it starts with. But it says there is a proviso. It says, the starting word says, save and accept as provided in the regulations, rules, and whatever. So what is provided in regulations, what is provided in the rules, you can do it. So for all these items, like when I said there is an inward remittance, where if there is a share to be acquired of your company by a foreign citizen or a foreign company or a foreign NRI, you have to follow that process. It is considered as allowed under this particular FEMA transaction. Similarly, outward remittances, also it is in the same processes. So there are regulations for that. What is the regulation for outward? What is the regulation for inward? If you want to see exports, there is a regulation for that. If you want to borrow money in foreign exchange, yes, there is a regulation for that. So for each and every aspect which you want to deal in foreign exchange, there is a regulation for that. Remittance of assets, all these things, there is a regulations and rules. Now, this is monitored by RBI and enforced by Enforcement Directorate. Now, department, the ED. Now, people are always having the skepticism of the ED, that ED is very difficult and very tough to handle, but it's not that way. I have appeared before ED, and there is not a situation where I have been, there is nothing to be scared about. They are also professionals. They are thoroughly professionals. Even RBI people are thoroughly professionals, and they know the topic very well. And if you are able to present your case very well, your matters will be heard well. So, of course, any non-compliances attracts penalty. In FERA, everything attracted prosecution, whereas under FEMA, 90% of the cases is under penalty, except some few cases which we will discuss. Prosecution is involved. Now, I will share with you very interesting thing about the FERA. I just passed my CA and I was practicing. Very senior industrialist, very seasoned and very systematic, very compliant company undertaking. They were raided by income tax or what some person, and they found some $100 note in their possession, $100 note. And that man, the MD, was arrested, very old man, very senior citizen. He was arrested just for possessing $100 in their pocket. Today, under FEMA, you all individually can hold in your wallet $2,000, no questions asked. Because $2,000 is the limit up to which you can hold individually as a foreign exchange. So there is no $100 is passed. Now, as I said, there is an opportunity, untapped market potential, because there is hardly, very few FEMA professionals operating all over India. And it's something not considered as a regular practice area, but definitely it helps you in your normal. I'll give you one more example of how your this FEMA knowledge will help you in your normal practice also. Suppose you have a client whose son is going to US for a job. Okay. Now, the day he has got all the savings account or current account or FD's account or shares and everything in India. Now he is leaving on a particular date for a job. In US, has got a employment visa and he is traveling. The day he travels, he is supposed to convert all his bank accounts into a non-resident account, either NRO or NRE, and he is not allowed to have any ordinary account in India. He is supposed to convert all his accounts, even his FDs, even his, even he has to intimate even the companies where he has got shares or mutual funds that he's become non-resident, and all these things we miss out because of lack of knowledge. And this is a tax penalty. So this is where, and I'll tell you why it attracts penalty. Tomorrow you said, what is so great about it just because he has not converted their ordinary to NRO? Why? Because after his accounts are converted into NRO and NRE, the bank which is holding this account is required, duty bound, to report to Reserve Bank of India on a monthly basis about all the transactions that are happening in this NRO and NRE account. And if their account is not converted to NRO and NRE, the reporting has not happened. So that's the reason that is a non-compliance, and that is a serious violation. It's seen that way. And this is what we have seen in many cases. Because of ignorance, this has happened, and unnecessarily it has caused a lot of inconveniences to people. So huge demand for professional certification. Yes, certification by chartered accountants. When suppose if you are an auditor, statutory auditor of a company, and that company wants to open a branch office or open a subsidiary outside India and wants to invest, remit money outside India for this, there is a requirement that the only statutory auditor can certify. No, any other chartered accountant cannot certify. So statutory auditor is required to certify one Form E of that particular form, which has to be filed with the bank to remit this money. And that form says that whether this compliance is under the FEMA before this remittance is made has been done or not. So if you are not aware about a FEMA, how will you certify? And if you cannot certify, the client will be suffering. Either he will not be able to make an investment, or he will have to look at changing the statutory auditor. So there you might lose out on your main practice also because of your having any knowledge on the FEMA matters. So this also is going to help you. Lack of in-depth knowledge on the subject. So there is a fear of unknown. Okay, I don't know something, so it is very difficult. But no, after 1.5 years or 1.5 hours, which you will be with me, you will realize that FEMA is very, very easy. It is not that difficult. And as far as the ED is concerned, I already told you it is nothing to be feared about. They are very reasonable people. They are very professional people, and they listen to you correctly. Now, as I already told you, these are the compliances. Even as a statutory auditor, you are required to certify some forms post investments also. APR form is there. ODI I already told you. Then any remittances, 15 CA, 15 CB, we all must be doing it. So 15 CA, 15 CB also is not only income tax, but it is also part of the FEMA. Then you can also become advisor to the client on the FEMA matters, compliances. You can implement various foreign investments and FCTRs and ODIs. Valuation of shares is also one area which we can do. Compounding and representation. When there is the non-compliances, there are two options. There are two things. One, there could be if it is RBI has detected, or if the ED has detected any non-compliance, then the penalty will be initiated. And penalty is 3 times the amount involved. Huge. Suppose if there is a 1 million of remittance coming in, $1 million US, 8 crores, and if you have non-complied with that, 24 crore will be the penalty amount. Okay, and if you find yourself that yes, you have not complied on your own suo moto, then you can go for compounding, like we do it in TDS. There is a compounding processes. So you go for apply for compounding, the cost is much lower. You can get a compounding order for they will charge you only compounding fee of 1% or 2%, depending on the magnitude. There are criteria for that. There are rules for that. Now, what is the hierarchy of the act? This is the Foreign Exchange Management Act. As I told you, it is an act. Then there are regulations. Now, who has framed the regulations? Who is supposed to form the regulations? It is the Reserve Bank of India who frames the regulations. And there are foreign exchange management rules. Who frames the rules? It is the central government who forms the rules. And what is the difference between regulation and rules? Regulation will tell you what you can do, what you cannot do. Okay, simple. It will tell you, if you want to bring the investment in India, you can invest. That investment can happen only in certain types of instruments like equity share, compulsorily convertible preference shares, compulsorily convertible debentures. You can't do it in optionally convertible or redeemable preference shares. You can't bring the money in. So this is what the regulations will tell you. Whereas the rules will tell you how to do it, how to bring the money in, what are the procedures to be followed, what is the process to be followed. That is the rules. So regulation will define what to be done. Rules will define how to be done. Now, master direction. Initially, earlier, they were issuing press notes, notifications, circulars, they were issuing FAQs, all this the RBI was issuing. Now, see, if you want to look at income tax or GST, and you want to understand a particular topic or to find out, some conflicting areas, you will have to go into the act, rules, you will have to also see the judgments, notifications, everything you will have to see. Beauty of this FEMA is what? RBI issues master direction. You go to the RBI site, search a master direction on the topic which you want. Suppose you are looking at foreign investment in India, master direction. You will get the latest master direction from the RBI, which will contain all the provisions, amendment till date. So you will get a correct law, what is happening, what is today's prevailing law, and you can just go by that law and then go ahead with the compliances. So master directions are actually not for us. It is meant for the AD bank, because RBI has to instruct the AD bank regularly. AD bank is supposed to work as per under the instructions of RBI, and they are the delegated authorities of the RBI. So naturally, they have to be guided as to how they will implement the law. So these are the master directions available on the website of RBI for the banks, but still we can utilize. There's no harm in utilizing. We can see that, and we will know what is the compliance required. So when you go to the AD bank, you know already what is required to be done. Now again, just to recap the section 46 authorizes and gives powers to central government to make rules. I told you 47 gives RBI the power to make regulations, and 48, now here this is very interesting. Sometimes people challenge these rules and regulations are by the bureaucracy. It is not by the It's by the government. It's not by the parliament. Parliament is a law-making authority. So how does it get the power? How does it get the authority? So 48 requires that all these rules and regulations will be placed before the parliament, will get approved, and after that only it will be implemented. So now it gets it's like a law. Then it becomes it has got a force of a law. So this is what I already explained to you. Some major regulations under FEMA is permissible capital account and borrow money from outside India, or how do you lend outside India in rupees? That also is explained. Deposits, like you're opening an account with various banks, NRE account, NRO account, FCNR account, EFC account, RFC. Even the residents can have a foreign currency account under the favor of RFC. Resident foreign currency account. So you can also have it. Exporters can have export earners foreign currency account. So all this is what can be deposited in this account, what can be withdrawn from this account, all that is explained under this particular regulation. Then acquisition and transfer of movable property outside India. So if you want to buy a property outside India, what are the procedures to be done? That is given here. Realization, repatriation, and surrender of foreign exchange. Now this $2,000 which I told you is covered here. Retention, possession and retention of foreign currency. Realization means I told you about it 9 months. It covers, and it is coming under this. Remittance of assets. The FEMA is now very liberal. It allows you, I told you, $250,000 you can remit as a resident outside India every year. So, and for a non-resident, the limit is $1 million, about 8.5 crores. So you can, a non-resident Indian can remit, $1 million every financial year out of his NRO account, which may not be repatriable other way around. It can be remitted outside India. Now, these are the non-debt rules. Non-debt means equity, capital. This we call it capital. So this is earlier, there were 2 different regulations which has been superseded by a non-debt rules. One was transfer of issue of security by person resident outside India. Matlab, a person outside India is investing in India. That regulation, and acquisition and transfer of property in India. Both these provisions have been subsumed under non-debt rules. Investment in firm or a proprietary concerns in India. I told you earlier, LLPs and all that were not allowed any foreign investment by any person, but now LLP also is permitted to get this. So I will quickly move into the various aspects, because then otherwise the time is short. It's a very in 2 hours I have to cover a very vast topic. So with this PPT, maybe I will request the committee to share with you all the participants. Some of the important rules I told you: current account transactions, you can do whatever you want as far as the current account transactions are concerned. Remitting money for maintenance of your relatives outside India. You want to go for education, you can remit money for your fees. If you want to go, if you have a medical treatment, yes, you can spend money for that also. Then there are compounding proceedings, how it has to be done, the rules are there. Overseas direct investment rules are there. Non-debt rules are there. So master direction, I've already explained to you. Now, these are those sections which are aligned. 2 section, of course, is always definition. 3 to 9 is the basic concepts. 13 to 15 is the contravention and penalty. 16 to 35 is the adjudication and appeal. If you don't agree with the penalty, then you can go in appeal. For compounding, there is no appeal because it is suo motu. And section 36 to 38 is the enforcement directorate, their powers and their authority. And section 39 to 49 are miscellaneous provisions. Now, very basic important principles in FEMA. What cannot be done directly should not be done indirectly. Don't even try. Don't even make an attempt. What you try to divert, try to circumvent the law and try to do it in a different way and avoid the law. Don't do that. You will get caught, because the law does not permit whatever is not specified under the regulation. So you do not try to circumvent the law. What cannot be done directly, this is the principle you should always keep in mind. Now, when there's another thing also. When any outward remittance is going out of the country, there are 2 things one has to always check. One is whether it is permissible under the FEMA law, whether it is allowed under the FEMA law, under this. And second, whether the full tax has been paid on that particular transaction or no, as applicable. Whatever, if there is a DTA and there is no tax applicable, okay, fine. But if there is a tax applicable, then the tax has to be deducted. No money can be remitted outside India, wherever applicable. If it is not applicable, it's fine. But if it is applicable, then you require to be deducting the tax. 15CA, 15CB is what we file for the tax deduction, and it is a chartered accountant who certifies 15CB. Now let us look at some. I told you about this. FEMA, initially the sections are all closed. All the doors and windows are closed. You can't do anything. If you read this word, forget the red line. You read this word. No person shall deal in or transfer any foreign exchange, make any payment, or that means it says no, you can't do anything. But you read this red lines. Save as otherwise provided in the Act, rules and regulation. That means you cannot do it, but only what is provided in the rules and regulation, you can do it. So you have to now go into the rules and regulation and see what is provided, and then you can do that. Similarly, all these provisions are there on the current account has been defined. Now, current account is where the money is, it is not necessarily fixed assets or whatever. Fixed assets can also be considered as a current asset if you are buying from outside India. Now, what is a capital account transaction? A capital account transaction is a very simple principle you have to apply. If you are in India, as a resident, any assets or liabilities outside India is changing because of that transaction. You are acquiring property outside India, you are borrowing from outside India, or some shares are coming from outside India, then those are capital account transactions. And for a non-resident, if their asset or liability in India is changing because of that transaction, then it is a capital account transaction. Buying property in India, buying shares of the Indian company, all this will be capital account transaction. Lending to Indian companies also is a capital account transaction. Now we go to, these are the schedule 1 of capital account. Which are the capital account transactions which are permitted? Is investment in foreign securities, which a resident India can do. He can buy foreign securities. He can, foreign currency loans he can raise in India. He can avail the ECBs, which is at a cheaper rate. If you can get the labor, it's about 3% or 4% compared to what you pay about 12 to 13% or 14% in India. But then you have to factor the foreign exchange loss also, because the foreign exchange risk is always on your account. Because you have borrowed in dollars, you have to pay in dollars, and if the dollar appreciates, then you pay much more than probably the interest cost. So that hedging and all that you will have to take care. But otherwise, the interest rate is low. Transfer of immobile property outside India, which you can do as a person resident in India. Guarantees issued in favor of resident in India. Then even maintain loans and overdrafts from a person resident outside India. Maintenance of foreign currency account. The resident can open an account in UK or USA or wherever Mauritius. They can open an account and transfer $250,000 every year. Insurance policy outside India. And what a person resident outside India can do? Investment in India of a shares of an Indian company or an entity. Investment in India in a capital of a firm or an LLP, which I told you it is now permitted. In acquisition and transfer of property in India. Guarantee in favor of resident. Deposits with resident in India. Foreign currency accounts in India he can open. And remittances outside India. Now we will just take up quickly a key definition. As far as person resident in India is fine. It's one. Income tax, we have got 3 categories of person resident. 3 categories of person. One is the resident, pure resident. Then there is a pure non-resident, and one in between, resident but not ordinary resident. In FEMA, there is no such in between category of resident but not ordinary resident. There is a person resident in India or person resident outside India. There is no third category. Now, within person resident outside India, there are 3 categories. One is the pure foreign citizen, like anybody who is a citizen outside India only, has got no in connection with India. Then there is a non-resident India who is an Indian citizen staying outside India for a job or employment or for any long-term purposes. He is holding Indian passport and staying outside India, so non-resident Indian. Then there is an overseas citizen of India. Suppose there are many people who go out of India, they go to US, they take up citizenship of US or other countries also. Then they become citizens of the other country, but they have roots in India. Since they have root in India, earlier it was called person of Indian origin. Now they have changed it to OCI. Now what is the difference? Person of Indian origin did not require his registration. Automatically by default, if he has got roots in India and it went up to father and grandfather, three lineal this. And if there were anybody who was a resident, a citizen of India, then they get a PIO status. So automatically, without even a person is born in US, but his father was a citizen of India, he will get a PIO status. But now they have removed that PIO status. They have changed it to overseas citizen of India. What is the difference? Now you have to register everybody, but the classification is same. The criteria is same. They will have to apply with all the evidence on the passport site. There is a website on passport where you apply for your passports. You apply there for your OCI card, and based on the criteria which you are meeting those criteria, you are able to get the OCI card. Now OCI card will enable you to come to India without any visa. Plus, they are at par with non-resident Indian in terms of all the facilities that they can do in India. Whereas there are a lot of restrictions for a pure foreign citizen to do a lot of things in India. They cannot buy, pure foreign citizen cannot buy property in India. Okay, so there is a difference. Whereas a non-resident in India and OCI can buy properties in India except agricultural land. Everything else they can buy. They can buy commercial properties, residential property. But a pure foreign citizen cannot buy a property in India. Now, this is very interesting. This is the definition of what is a person resident in India. So, who is not a resident in India will become automatically person resident outside India, like how we have in section 6 also. What is the definition of person resident in India? Earlier, this 182 days criteria was not there. It has been subsequently introduced. Earlier, it was only intention. But now they have introduced even number of days. That means if I have stayed for more than 182 days in the earlier preceding financial year, I am a resident in India for the current financial year. I am still staying in India, so there is no issue. So I am a resident for FEMA. Income tax and residential status and FEMA residential status can be totally different. I can be a resident for income tax and I can be non-resident for FEMA. I will give you an example how it works. Now, as far as suppose I have stayed for 182 days or several days, 365 days last year in India. Now, in May, on May 14th, I get a job offer from US and I leave with a visa of US visa, with an employment visa, I leave to US. So on the day I leave India, I become person resident outside India, irrespective whether I stayed all along in India for so many years, it doesn't matter. If I have left for my employment on the day, that day I become a person resident outside India, whether for employment, whether for business, or for an uncertain period. Like, for example, I am not taking a job or a business, but I have got my children over there and I am going to settle down with my children for long term and I have got a long-term visa, which is over a period of several years. Then I become a person resident outside India the day I step out. I get into the flight. So what I have to do, I have to intimate before I leave all my banks, get an acknowledgement that yes, I am going out as a person resident outside India. This is my visa, this is my passport copy, this is my ticket. And from that day, I become a person resident outside India. And please convert all my bank accounts with you or whatever it is into a non-resident ordinary account. So whatever you want to do it. Intimate your companies, intimate wherever you got a share, mutual fund, and then leave. Otherwise, you might get into a non-compliance mode. Now, suppose I have come to India during the year. I have the first category is where I have gone out of India. Now, the second category is where I have come to India. Now, when I am coming to India for taking up an otherwise then for taking up an employment, otherwise then for carrying on in business in India, otherwise for the purpose of any long-term stay in India, then I still remain person resident outside India. I don't become person resident in India because I've just come to India. No. Yes. Now, this is a very controversial issue. Yes, I will tell you. There was a judgment of one Delhi, I think Delhi tribunal, or I don't remember, Hyderabad or Delhi tribunal. And that said, okay, when this particular second part applies only when you have stayed for 182 days. It has to be read in conjunction with 182 days and coming to India. So if you have been staying out of India for so many years and suddenly on one fine day you come to India, you give up the job and you come to India, then on that day you don't become a resident in India. You have to stay for 182 days and then you become a resident. And there was a very interesting case. What happened is that person came to India in May 2012 for taking up an employment, assuming that he has become resident. He acquired a agricultural property which a non-resident cannot acquire, and he used the money from his own personal that NRO, whatever the NRO account was there, from that whatever money he had brought in from outside India, from that he used that money. But the property he bought in the name of his wife. In spite of that, there was a notice from ED, and there was a penalty levied on him because of this transaction. So we have to be very careful how we deal with this. OCI, I already explained to you what is the OCI. Now, there is very interesting thing. BRICS is now coming in. Earlier, the main universal currency was dollars. And of course, when you are billing outside India for your exports, you can bill it in dollars, you can bill it in Indian rupees, or you can bill it in the currency of that country where you are exporting the goods. So that is all permitted. But dollar is also acceptable currency all over the world where you can bill. Now, sometimes people think that, oh, when I'm billing in Indian rupees, is it a foreign exchange? Yes, it is a foreign exchange. The reason is very important, very simple. In case of billing in dollars, when you receive the money, you get the benefit of the exchange gain or loss. I mean, it can be loss or gain, because if the US dollar fluctuates, then you get the higher money or lower money. Whereas in case of Indian rupees, you will not get any benefit. Whatever you have billed, you will get the same money. Now, when it is Indian rupees, you have billed in Indian rupees, is the customer who is going to convert that dollar, is going to buy the Indian rupees from the foreign market and send you the Indian rupees as against the dollars. Whereas you will receive Indian rupees. Whereas in case of a dollar, he will make the payment in dollars and he will convert that dollar into Indian rupees in your Indian market. So it is either way the currencies which are being converted. Now, of course, BRICS is being promoted. It is Brazil, Russia, India, China, and I think it is Sweden. I'm not sure, but there is another country which is also there. Now, who is an authorized person? Authorized person is the person who is being delegated the powers of the RBI, and it's a bank basically. But there are others also. But there are authorized dealer and authorized person. Authorized person is a larger term. Authorized dealer is the smaller. It's a subset of that. Authorized dealers are banks who can do any transactions for you, remitting money outside India, collecting money for you, all that he can do. Whereas there are certain authorized persons who cannot do normal transactions. You can only do money changing. For example, if there is a foreign citizen coming to an hotel in India and they have got dollars, they will accept dollars, but they can't do transactions in dollars. They will have to immediately deposit these dollars in the bank the next day and hand it over to the bank. They cannot keep it with them and they cannot become the exchange. They can't do that. Okay, so they can only collect foreign exchange from the customer. So these are the things. If you have gone to some foreign countries, you will find every corner some kiosk where you can buy it and sell foreign exchange. Here you can't do that. Now, control. We all know control is our normal parlance, that anybody who is holding more than 50% shares is having control. There is subsidiary or having a majority shareholding in the company. So you have a control over that company and you consolidate also. That is fine. But under FEMA, when you are making an overseas investment outside India, the control definition is different. It is not 50 plus. It says 10% or more. Now that means if you have invested outside India in any company, and if you are holding 15%, then also you just deem that you have got a control over that company for the purpose of FEMA, not for the purpose of your Companies Act and consolidation. It is not for that. Now, how does it work? In overseas investment, you are required to file one annual performance report every year with the Reserve Bank of India. It is to be done on 31st, before 31st of December. For example, if you have a company subsidiary if you open a subsidiary in US and the calendar year is the financial year is the calendar year, and they close their accounts on 31st December 2024. So that details and APR has to be filed by 31st of December 25 with the AD Bank. It is manually filing. There is no online. There are most of the forms in RBI online, except this APR, which has to be filed manually. Now, there is a requirement. Earlier, 2 years back, the requirement was different. It says that you can have to attach the balance sheet of that foreign subsidiary, foreign company, and along with that APR form. Now, in US, the law is like this: you don't require audit unless it is a publicly traded company. So if it's a private entity, you don't need an audit. It is a management certified financial statement. Now, earlier, this management certified financial statements were permitted to be attached with the APR. Now, this is no. Only we have to attach the audited accounts. Now, even if the audit is not applicable in that country, you will have to get it audited. Even locals, Indian CS can do. There is an opportunity for all of us. Indian CS can do audit of a foreign entity, a foreign company, and submit that copy only for the purpose of FEMA. Of course, since there is no filing with the foreign entity, there is no need for a local chartered accountant, local CP over there. You can, as a chartered accountant, certify and sign a balance sheet and submit with the APR. So, but that is only when you have a control. That means if you have got 10% or more shareholding, then only this is required. Otherwise, it is not required. So that is where this particular thing comes into play. Net worth. This is very important. When you want to make an overseas investment, the rule is that you can any Indian company can invest in a foreign entity up to 4 times its net worth. That is 400% of its net worth. Now, what is net worth? As far as Indian company is concerned, we are all aware that we follow 2 different gaps. One is the normal accounting standards, which we are following, AS1 to AS29, and then there is another is Ind AS. Now, if you look at the working of the net worth in both, this is totally different. As far as our normal gap is concerned, redeemable preference share is part of net worth. Okay, whereas a debenture is not net worth, it is borrowing. Okay, whereas in case of Ind AS, redeemable preference share is not part of capital, it is shown as a borrowing. Whereas a compulsorily convertible debentures will have some element in the net worth. So there is a totally different working of net worth under Ind AS and AS. But the laws now, the FEMA says you have to go as per the audited financial statement. So if the audited you are under Ind AS, you see whatever is as per the audited financial statement, whether debentures have gone into net worth and redeemable preferences have not gone into net worth, so you can't consider. You can consider only what has gone into your net worth, what is the net worth, and of that 4 times you can invest. So this is very important. Now, another thing, another very interesting principle is what is the audited financial statement. Suppose, for example, I have got a newly formed company. April 25, I have formed a new company. Okay. Now, I don't have a March 25 financial statement. I don't have audited financial statement of March 25. Now, it is the April 25 company is incorporated. And I have got a huge capital introduced from local source. And I have put in, let's say, 1 crore rupees of capital in that company. And now I am in September or October. And I want to now invest 4 crores to one US company. The company has got a capital of 1 crore, the net worth is 1 crore, there are no losses, there is no expenses, it is a clean company. Now, I want to invest 4 crores. Now, how do I do about it? I don't have a March 25 audited account. So what do I do? Shouldn't I invest? Yes, I can invest. You can, the wording here uses audited financial statement. It doesn't say annual audited financial statement. That means I have to make an audited financial statement for an interim period, let's say up to 30th September. I will make out an interim financial statement, get it audited, no limited review, audited. And the chartered accountant, statutory auditor will audit it. They will have a net worth, and based on that net worth, you can remit 4 times the money. So it is not necessary that we should have annual audited accounts. Okay, another thing, you have, let's say, one audited financial statements. The validity of that audited financial statements is 18 months. Very simple logic, very simple logic. Suppose March 24, you have got an audited financial statement, right? Now, that is valid for September up to September 25. The reason is very simple. As far as March 24 is concerned, you have March 25 is concerned, due date for preparing the audited financial statement, the AGM is 30th September 2025. Correct? So till the time you may not have March 25 account. So March 24 audited accounts are still valid till September 25. But once you cross September 25, you are on October 1st, 25, then you cannot utilize March 24 accounts. You compulsorily have to go by March 25 accounts. And if they have extended their AGM and all that, then you cannot, you have to have an interim financial statement, audited account and all that. You cannot rely on March 24 financial statement. Now, another one very interesting stuff. Suppose you have invested based on March 24, let's say March 24, the net worth was 1 crore. The company has invested 4 crore rupees outside India. Now, in March 20, you are in September 25 and you have utilized March 24 financial statement for investment in outside India. Now, in March 25, there is a loss. And because of that, the net worth has gone down. Now that 4 times the criteria is not met. after the March 25 audited account. But no, doesn't matter. Your March 24 account was still valid when you remitted. There was no March 25 audited account. So you were justified in remitting whatever amount you remitted, and you don't have to call back the investments. It is valid. But if your March 25 accounts were ready and signed off, when you remitted money, yes, you have to use March 25 account. You can't use March 25. So this is the criteria which you have to do in the compliances. And as far as the compliances are concerned, it is our auditor's responsibility to certify. Now, deposit regulations. As I told you, NRO, NRE accounts. I will just quickly explain you the difference between you. Of course, you all must be knowing what is the difference between NRO and NRE. But I will explain you in a different way, which you will never forget for life. You all have traveled outside India. When we travel outside India, we pass immigration. When the immigration stamp is put, exit stamp, where the date is there, and they will ask you questions whether you got visa, why are you traveling out. And after you have explained that satisfactory and he is comfortable, the immigration officer will put a stamp on your passport and then you are allowed to go out. Now you are waiting at the gate. Now when you are waiting at the gate, you are technically outside India because your passport has been stamped, exit is there, you are out. But physically you are still in India because you are there. Now this NRE account is like the person sitting at the gate. It is technically outside India, but physically in India because you can open an account just next door in your bank and it is in India. So you have an NRE account in India, but technically outside India. The logic is this: any money lying in NRE account is freely repatriable, no questions asked. No AD bank can question you. If you have got $1 million, $100 million in your NRE account, tomorrow you can tell your bank, I want to transfer it to Switzerland, I want to transfer to Sweden. No bank will ask you why you want to remit, whether the tax has been required to be deducted, no immigration required because you already crossed immigration. I'm saying you have crossed immigration. Now it is just boarding the flight and leave. Similarly, your money in NRE account can leave outside India. And similarly, if your money is coming into NRE account, again, no questions. It can come into from outside India and stay in NRE because when we do a transit, we are traveling in transit. You don't have to clear immigration. You can do freely wherever you want. Now, NRO account is before this immigration. That means if you want to remit any money outside India from NRO to outside India, you have to cross immigration. Now, what is immigration? Immigration is justifying why you want to remit out of India. Secondly, TDS, tax deduction, 15CA, 15CB. So at that stage, the AD bank will ask you why you want to remit, whether you are permissible to remit. Yes, if you are permissible, you can remit from there. And plus, whether the tax has been properly deducted on that, whatever remittance you are making. So 15CA, 15CB is applicable when you are remitting from NRO account. Now, deposits in NRE account from the local source will require all immigration because if the money is in India and it is now moving to NRE account. Like you can suppose you have a rent income in India. The NRI has got a rent income in India. It can, instead of directly remitting outside India, it can deposit either in NRO account or it can deposit also in NRE account. Once it is deposited in NRO account, no compliance because it is before immigration. It is a local account. Whereas if it is if you deposit NRE, it is after immigration. So then you need to comply with 15CA, 15CB and all the compliances and then deposit in the NRE account. And once it is deposited in NRE account, the money can be repatriated. NRO account, once it is deposits is easy, but when you have to take it out in outside India, then you have to comply with all the procedures. But yes, one thing you must understand that when you are talking about FEMA, now this is FEMA, but when you're talking about income tax also, income tax 195 is very clear that when any payment to a non-resident, irrespective wherever you deposit, you have to deduct tax and comply with the 15CA, 15CB. So if you are depositing any income in it, even in NRO account, FEMA may not require, but the income tax will require you to deduct tax under 190. So this is the difference between these two basic accounts. And then there is FCNR account. FCNR is designated in the foreign currency, so you don't lose out on exchange. Because if you have got NRE account in Indian rupees, then you have got a exchange risk. And under NRO, you have NRIs, because NRO can be opened only by NRI. So NRI can, or OCI, both can open NRO account. NRO account, you can remit $1 million every year to per NRI. You can remit outside India wherever they want and no questions asked. So these are the current account remittances you can make. You can, if the NRI having some dividend income, interest income, rental income, other current income, it can be remitted. That 1 million doesn't apply. 1 million is over and above. So if this is extra, you can remit. If you are remitting any sale of property, and if that property was acquired out of the foreign funds, you can remit money outside India. If you have acquired shares from the foreign remittance, it is a repatriable. And once it is repatriable, when you sell, the entire sale process, including capital gains, can be repatriated outside India. So it doesn't go under that 1 million restriction. Over and above anything is there, it can go under 1 million. Suppose if it was a non-repatriable investment, and now if you got money here, you can send it out under 1 million. I'm going slightly fast because the topic is too vast, but we have to justify and explain you a lot of things. Current account transactions are divided into 3 parts. One is the prohibited items. You know what lotteries and all those things are prohibited items. You cannot remit money for that. So there, irrespective, nobody can approve. Even RBI cannot approve. Even the government cannot approve because it has been prohibited by the parliament. So you cannot do anything from it. Then there are restricted items with permission. So there are certain items where you need a permission of certain people. So for that, there is a list in Schedule 2. And Schedule 3 is generally allowed with limits. Okay. Consultancy fee, you want to pay to an architect in Singapore, you can pay up to USD 1 lakh per year. Then maintenance of close relative, no limit. Gifts from resident to non-resident, only up to $250,000. You can't do more than $250,000. Medical expenses, as per estimates from hospital. Now, this is very interesting. Suppose somebody wants to go for a medical treatment, and we know that medical expenses in US and other countries are very expensive. And suppose, I'm just giving a hypothetical example. Generally, you are a resident and you want to you want to do medical treatment in USA. You as per LRS, you can only remit 250,000. But suppose the hospital estimate is, let's say, $5 lakh. You can remit up to $5 lakh. There is no limit here because it is as per the estimate from the hospital. And yes, medical treatment is a necessity. So for that, the government says we will not put any restriction. You take the best of the treatment. Education, again, generally we always have seen the word lower, but here it is higher. Higher of the estimate from the university, whatever fees they have stipulated from the university, or 30,000 per academic year, whichever is higher. Suppose the fees are 25,000, you can remit 30,000. If the fees are $1 lakh, you can remit 1 lakh. So why they want it that way? Why the government wants it that way? Because our people who go for education should not be in a difficulty, should not have a problem of spending. They should not be without money. So that's the reason we are giving them the benefit of taking money out. Remittance of asset, I already told you, NRI and OCI can remit up to $1 million out of India. As far as cannot gift up to NRI, a resident cannot give more than 250,000 to an NRI. I'll give you a simple example. There was one very interesting case in one of our clients' case. A client, one daughter was a non-resident, whereas the father was a resident. Now, non-resident, that daughter wanted to buy some property. So she was eligible to remit under 1 million scheme, but she didn't have any money in the NRO account. So father gifted $1 million to her in her NRO account. And she wanted to remit that money outside India. We said, no, you can't do this. So first of all, father cannot give more than 250,000 to a non-resident daughter. And that money, maximum she can remit is 250,000 out of that gift. If she has got other NRO balances, from that she can remit, but not out of the this gift. As far as LRS is concerned, it is important that it should be from your own source. It cannot be from the borrowed source. You can't borrow money and remit for your property outside India or sales outside India. You can't do that under LRS scheme. And the remittance, of course, as I said, should be net of tax, 15 CA, 15 CB, FEMA declaration, and A2 has to be given. The same thing which I mentioned to you is mentioned in this particular example. Then there is a case study too. When you are remitting under 1 million scheme, there is no TCS, but if you are remitting under LRS, then there is a TCS. This is the non-debt rules. I will do one thing. I'll quickly complete within about 10 minutes. I will complete this and I'll go to FCRA because FCRA also is a very important topic. Now it is non-debt rules. Now we don't get into the slides. I will explain you the entire process. Now, if you want, let's say a company in India wants to have a foreign investment. So first we will have to find out which instruments you are going to issue. Now under non-debt rule, you can only issue equity. Yes, equity is equity. Then you can only issue compulsorily convertible preference shares, compulsorily convertible debenture. You can't issue redeemable preference shares. You can't issue optionally convertible debentures or optionally convertible preferences. First you decide that. Then at what price you are going to issue. So you have to do a fair valuation of that share under DCF method, because it doesn't mention DCF. It says internationally acceptable method, which is generally DCF for a going concern. We all know we are chartered accountants. So we have to value the shares of the Indian company based on the DCF. Now we know when the money is coming in, it cannot be less than that value of that, the fair value of the share. It can be higher. It cannot be less. Now I will give you an example. Suppose the value comes at $100, and you can allot at $100 or you can allot at 101 or 110, no problem. Now even that income tax thing is gone, 5627B is gone. So then that income tax taxation is not there. Now, if you have allotted at 99.99 rupees, suppose 100 rupees is the fair value, and you allot at 99.99, you say, oh, 1.01, maybe translating it to some few lakh rupees or something like that. And you have received a huge amount from the foreign investor and you allotted shares. RBI will levy penalty 3 times on the entire amount you receive, not only on the difference, because the entire amount becomes non-compliant. You have not followed the regulation. As I told you, you have to go specifically to the regulation and see what is required and you comply with that. You cannot circumvent by, oh, chota sa dega nahi, no, chalega nahi. Okay, you have to have 100 means 100. It cannot be 99.9. Otherwise, the entire amount of non-compliant. Now that is second as far as the valuation. Money has to come in from a foreign investment or from a outside investment, outside remittance, or to NRI account. NRI account, as I told you, is outside India, technically outside India. So money can come from an NRI account to NRI account to, not from NRO, NRI account to this company's account. And you receive all this money. Okay, you have to get a KYC from the foreign buyer's bank, and the money comes into it. And within 60 days of receiving the money, you are supposed to allot the share. Now, till that time, you are not intimating anything to RBI or to the bank or anything. You are doing your transaction yourself. It is all under open hand. And you have to see whether the company which is operating in India, whether it is under which sector. Suppose if it is then there is a sector given in this particular regulation. There are some sectors where it is 100% allowed, so there is no issue. Some sectors only 74%, some sectors 49%. There is called sectoral cap. So you can't allot shares to a non-resident more than that. Some sectors are prohibited. You cannot allot shares in a company which is carrying on activity of a prohibited item, agricultural activity. No, you can't do that. So real estate, buying and selling of land, not allowed. Yes, you can do a project, real estate project is allowed, but not buying and selling of land. So you're doing TDR business, you cannot get a foreign investment. So there is a prohibited list. You have to see that list. And you have to, suppose if there is, the item is that particular activity is not mentioned in a list, it is 100%. In some cases, even though it is 100%, there are conditions. So all that conditions have to be complied with when you get the money in. So once you get the money in, you have to get an FIRC, or that now it is not FIRC, the BRC, bank remittance certificate, which should mention that it is for investment in shares. And then within 60 days, you allot the shares. Now, after allotment of shares, within 30 days, you are supposed to file one form FCGPR with the Reserve Bank of India to online portal, and RBI will then give you a acknowledgement saying taken on record that the particular number will be allotted, and that number is very important when you want to exit, when an investor wants to exit and remit money outside India, then at that time it is important. And when he wants to exit, there is a form FCTRS, foreign currency transfer, to be filed within 60 days from the date of this transfer. So this is as far as there are other types of investments also. LLP, a person invests in LLP, then that LLP, there is LLP1 form to be filed. And when he wants to exit, it is LLP2 form to be filed. Again, here also there are certain sectoral restrictions which you have to look into that rules. It is given very clearly. There are chapters. Chapter 3 talks about investment for this FDI, which I mentioned to you. Chapter 4 talks about for foreign portfolio investor on the stock market. Chapter 5 talks about investment by NRI and OCI. They can do out of NRO account and bring the money in, and it will be non-repatriable, of course, but under 1 million scheme, they can repatriate. Then there is the investment by other non-residents. There are funds and all which can bring in. Then there's a foreign venture capital investment can come in. Immovable property. Now, immovable property, very important. Any non-resident or OCI can buy property in India except agricultural property. Or agricultural property can be acquired by a non-resident OCI only by way of inheritance, not by way of purchase or gift or anything. Okay, so if suppose the father is in India and resident and he has got agricultural property, he dies, and if the son is in USA is a non-resident, yes, he can inherit property, but he can't sell this property to any non-resident OCI. He can only sell to a resident. This is the entire table of that what can be done. Now there are those depository receipts and all that. There's a big topic and the time is short, so I don't want to get into those very detailed discussion on that. These are the other instruments on which you can invest in REIT, that is the real estate investment trust. Then there is the infrastructure investment trust, alternative investment fund, or mutual funds, where 50% is in equity because it is non-debt, it is not debt-based. Now, concept of DR, I already told you, it's a depository receipt like ADR, GDR. And now there is an Indian depository receipt also. We should be proud as an Indian to have an Indian depository receipt. That means a foreign company wants to tap Indian market. It will have a depository here. They will allot shares to the depository. The depository will in turn issue a IDR to a local Indian resident who will be buying in Indian rupees and not in US dollars. And this IDR will be listed on the Indian stock market. This is how the concept works. Same thing, which acquisition property, I already explained to you, NRI and PI or OCI can invest property in India. So except agricultural plant, farmhouse, they cannot buy. Other than any properties they can buy. They can only inherit agricultural property. They cannot take a gift or this. Now, these are all those case studies. We will quickly move to the FDI process and everything I have already explained to you. Now, I will go into overseas investment. Now, suppose if you're an Indian company, and a lot of things I already discussed earlier, if somebody wants to invest outside India in a subsidiary or not be subsidiary, it can be even 10% or 12% shares also. So you can buy shares of the foreign company. Again, restricted activities. You cannot get into real estate buying and selling of land wala activity, or there are other restrictions also. Then if you want to invest, first you have to check whether 400, what is the quantum. Suppose you want to invest 1,000 crores, whether your net worth is 250 crores, then you can invest 4 times your net worth. Now, if your investment can be made even by an LLP or a partnership firm, so the capital becomes the partner's capital is your net worth for the purpose of working out 4 times. Now, even individuals can buy shares outside India, but there is under LRS. Maximum amount is 250,000. Now, here don't look at the 4 times for an individual, but for others, it will be 4 times their capital. I already explained you the net worth, how it is to be computed. So first you have to see whether the sector is eligible. Then what is the amount you have to remit. Now, valuation. Now, I told you when your money is coming in, the valuation, you can allot the share at price higher than or equal to the fair value. Here, you cannot allot the price at lower than the fair value. Okay, so that is important because it is money is going out. Sorry, not more than the this. So you can allot at a lower price. You cannot allot at a higher price because the money is going out. So that is one restriction. Then another thing is that FATCA. There is this another section. Another thing we have to look at is FATF. FATF is the worldwide body which determines which countries are encouraging PMLA, money laundering, and all that, and they are putting them on a gray list. Now, this is published on a regular basis on the website of the FATF, which is there worldwide. You have to see when you are investing whether this particular country where you are investing, whether it is on the gray list. And if it is on the gray list, you cannot invest. You cannot remit money out there. So that is one thing. And then whether your company is under NPA. If you are NPA, how can you invest? then classified as a willful defaulter, or they are under investigating agency, or if there is then you require an NOC from all this. You are required to get sales certificate within 6 months from the date of this AD bank, and when the ODI when it's liquidated, the funds have to be remitted back. So these are the and this you have to find one form FC before remittance. Here when you inward remittance, all the form filing is after allotment. Here before remittance, the form has to be filed. And in that form, one certificate I told you about chartered accountant, that saying that it is compliant with the FEMA law. So I will quickly move to the, I think, FCRA, because we are already on 620. Now it's quickly, I'll just tell you contraventions. Contraventions, I told you 3 times the amount involved, and it is a 5,000 rupees per day for continuing offense. For certain violation, like what kind of violation? Suppose they find during your investigation, they find that you are owning some properties outside India, and it is not, money for that is not being remitted to the normal banking channels or permissible FEMA procedures. You have got more properties than what you are permitted to remit, and they find some assets. Then prosecution comes into. Another area where prosecution comes into picture is where they have levied penalty, and within 90 days, if there is no appeal or there is no justification, then, and if you don't pay this penalty, then prosecution comes. And now compounding is one thing where you go to suo motu, and then the fees are very nominal. And now they have introduced one new provision, less submission fees. See, there are some minor offenses. Your FCGPR, instead of 30 days, you have filed on 35th day. So, earlier it was compounding, and they had a lot of compounding applications, very difficult for them to handle. So they have come out with a late submission fee, and there are certain formula. You have to pay as per that fee or as per that formula, and you can get the compliance. So whether it is any annual filing, it is 7,500 irrespective of number of years. Non-compliance in respect of FCGPR or any transaction-related form, then it is 7,500 plus. Then there is a formula to be worked out, amount involved into 0.025% into number of years the default has been, and then work out that maximum you can have late submission fee for 3 years. Beyond that, then you have to go to compound. Now I will quickly go into the Foreign Contribution Regulation Act. As I mentioned to you in the FEMA, it was RBI, the Finance Ministry, and ED who were the regulators and the people who were managing and controlling this particular law. As far as Foreign Contribution Regulation Act is concerned, it is coming not under a Finance Ministry, but comes under Home Ministry. And regulating that officer, the policing person is the Central Bureau of Investigation, SCBI, and not the ED. So there is a total different connection. Now, as far as FEMA is concerned, the objective was different, is to regulate the foreign exchange. Your Foreign Contribution Regulation Act, the objective is totally different. It is a question of money coming into India. What is Foreign Contribution Regulation Act? Any foreign person is contributing to any NGO or to any organization, charitable organization or society in India for any activities, development activities in India, for the charitable activities in India. So if they are contributing, this contribution is regulated. Now, why it is regulated? Because there is a tendency, or there is a fear, or there is always a possibility that certain money may come into India for terror activity or for other illegal activities, and it can come through the NGO route, and there is a lot of security of the country is at stake. So for that purpose, this law has been enacted. Now, what is the principles governing this law? Now they have defined what is the foreign contribution. Foreign contribution means any money received, any donation received either by cash or in kind. It is not necessarily, it will be only in cash. So it can be even in kind. Any article having market value of 1 lakh or above, it's considered as a foreign contribution. Currency, whether Indian or foreign, doesn't matter. Any security, shares, bond, it is also considered as a foreign contribution. Now, there is something called deemed foreign contribution, which is the interest accrued on the donation is considered as a deemed foreign contribution. Now, what is excluded is that if a person has earned any income out there, it is not contribution. Suppose if tomorrow somebody goes and earns any income, or a resident in India you have rendered some services and you receive money. That is not a contribution, that is an income. So that is allowed. But anything which you received as a donation without rendering any services, without quid pro quo, then it is considered as a foreign contribution. Now, very important, foreign source. What is a foreign source? See, when we say NRI, non-resident Indian, who is an Indian citizen holding passport, but is a non-resident, he is staying in US, he can contribute any amount to any organization in India without any restriction. FCRA does not apply to that contribution. Very clear. It is not a foreign source. If you see the details of this foreign source, NRI is not covered as a foreign source. Now here we discuss about OCI, if you remember. OCI is a person of Indian origin who has settled in US and is taken up a citizen of other country, maybe US or other countries. Now, once he gives up the Indian citizenship and he is a citizen of other countries, then any contribution made by that OCI becomes a foreign source. So OCI has got a lot of similar privileges and benefits as far as FEMA is concerned, but as far as FCRA is concerned, it does not have any benefit or privilege. It goes under a foreign source. Now, foreign source will also include government of a foreign country or agency or such government, multinational corporations, citizen of foreign country, I told you. Now it will include even OCI and pure citizens also. Foreign company, trust or foundations are covered under this foreign source. Corporations other than foreign company incorporated in foreign country. Okay. Associations, societies or club registered outside India. Any international agency, UN, you have got some contribution from UN, you can't get it. If you have not complied with a foreign FCRA Act, you cannot get a contribution even from the United Nations. You cannot get it from the World Bank or IMF. These are all accredited agencies. There is nothing, no illegality about it. But still, an NGO cannot get a money from a foreign source of this type unless it has complied with FCRA. Now, what is the compliance with FCRA guidelines? Now, who can receive this FCRA contribution? Any individual, NGO, person and company, exclusion of those mentioned, section 3 of FCRA. Now, who is the 3, section 3? Very simple. Political persons, political parties will not be allowed, irrespective of whatever they comply. They are not eligible to receive FCRA. Even if they apply for registration, they will not get. So they cannot even think about getting FCRA. Then there is the publishing houses or the media, main media, who is the newspapers or public publications or those TV medias, NDTV or whatever those kind of TV anchors. They will not be in a position to get FCRA. Even if they want to register, they cannot register. And the third category is all the bureaucrats, all the government employees, judges, all these people who are MPs, MLAs, they are all part of the government and they are government employees. They also cannot get, they will not be allowed to get FCRA. Now, there is only exception is that when they go out of India on a delegation, and sometimes they get some gifts by those foreign countries, they give some gifts. That is also allowed subject to certain quantum, 1 lakh rupees, I think is the amount. If there is anything excess, they will take prior permission from the Home Ministry, and without that they cannot accept those gifts. Now, who are eligible to receive FCRA? One is that any NGO who's got a definite culture, economic, educational, social program can receive foreign contribution. Now, here there are 2 streams, 2 methodology of getting FCRA. First is that you get either registered with Home Ministry under FCRA Act, okay, and then you can get you are allowed to get the foreign contribution till the time your registration is valid. Now, any entity which has been newly formed for 3 years, they cannot apply for registration. So, after 3 years of existence only, and if they have activities, after 3 years only, they will be eligible to apply for this registration. Okay, so that is one thing. So, within these 3 years, what do? They want to have foreign contribution. Somebody is willing to give huge amount of donation to India, to this NGO, and they are not eligible for the registration because they have not completed 3 years. So, in that situation, they will apply for specific approval with the Home Ministry, giving the full details of that person who is willing to contribute, his consent, is saying that yes, I want to contribute. Then his KYC and his background as to what he is. Based on that, the Ministry of Home Ministry will permit only to the extent of the permission sought. Suppose if they have said $5 lakh, only $5 lakh they can get. And again, that $5 lakh will come into a specific account, FCRA account, which is, I think, with State Bank of India only in a particular branch. You have to deposit that money in that branch. And when you utilize that money, you have to give the full breakup and the chartered accountant certificate saying that how that money was received and utilized. You cannot mix up any other donation with that account. Only that specific donation only will go into that account. And from that, what was the purpose of that donation? Only for that you can spend. Now, if you recollect, RPG in the starting initial, or you mentioned that so many NGOs got their licenses cancelled because they did not comply with various provisions. They had mixed up the local funds with the foreign funds. They did not use it for the purpose for which it was called for. They did not obtain the CS certificate and submitted the returns in time. And all these things, non-compliances have happened. And or suppose, for example, they got a $5 lakh approval, they got $6 lakhs gone. That is a non-compliance. So that invites huge penalties, prosecution, because FCRA has got prosecution. FEMA was more of civil, whereas FCRA has got prosecution. And plus their license will be cancelled, and a lot of CBI will start inquiry, and they will find out what is the source of that fund and how that money was utilized, and all that thing they will start looking into it. So, and so if specific approval, or even if you get registered, after that also compliances are very much there. You have to have a separate bank account for that in State Bank of India, a designated branch, where you have to deposit this money, whatever you receive in that account, and from that only you can utilize for the purpose for which you have got it. And you have to give a certificate from a chartered accountant of the source which you have received and the payment which you have made out of that account with all the details of the expenditure. And the chartered accountant is going to definitely verify the vouchers, bills, everything, and then only they will give certificate and then submit that copy to the Ministry of on an annual basis. It is on annual basis the form has to be filed, and it is online certification, so you have to submit this form online. Now, as I said, parties who cannot accept: government, political parties, companies associated and engaged in production broadcast of audio, video, news, current affairs program, people above association engage in print media, whether it's a print media or audio, video, news. Then there is the publications, all the publications also. Then there is this even public servants, member of legislature. I told you, MLA, MP, they cannot also get. Even they apply for registration, they will not get it. There is no question of applying. Employees of any corporate body controlled by the government, so even they cannot apply for it. Candidate for election, they cannot apply. The reason is very clear. Why? The reason is India doesn't want, the government doesn't want the foreign sources, foreign powers to influence political parties here in India or media, because media is a very, very important source of information. And today it can influence all of us about their news. And if it is controlled by giving some donations from outside India, then there is a possibility of a bias coming in. So government doesn't want that bias. They want an independent media. And for that, they said, these people will not get any foreign source. They will be independent, and they will not collect any money from the outside India. Now, yes, person 3 can accept, as I said, salary, wages, scholarship, or remuneration due to him. It can be collected. That is an income. It is not something which is free. He has rendered service and he has got the money. Payment for international trade. Yes, you are doing international exports, trade. Yes, payment can be received, no issue. Now, any contribution or a gift from a relative is allowed, which is not more than some lakhs in a financial year, should inform central government within 1 to 3 months. So that is what in Form 1 you have to inform within 3 months. So if you receive a contribution, it's any person receiving FC relative. Remittance is ordinary cause of business to post office, not covered. And gift as a member of Indian delegation, I told you, subject to central government rules. There is a central government rules that what we can accept as a gift. And if something which is more than that, you cannot accept. So it has to be, you have to take permission, prior permission from the central government. Restriction on use of, it shall be used only for the purpose for which the foreign contribution was received. Now, see, when there are two things. When it is a prior approval, you have to give the purpose. When it is a registration, then purpose is not required. It is for your normal operating level. So you can utilize the way you want it, but you have to give the account. As far as the specific approvals are concerned, you have to initially say that what for you wanted, what is the purpose, and then only you will get it. And then, one more thing, very important. This whatever contribution you receive has to have a serial numbered receipt book, which is not to be mixed up with any local receipt book. So it has to be having the specific receipt book numbers, and that receipt book numbers have to go in the serial. If there is anything cancelled, it has to be original, has to be attached with it. You cannot have a cancelled receipt. It cannot be, if it is, even if it is online, there has to be a cancelled thing which is there with you. FC received as per this act should be used for should not be used for any speculative business, because it is not the objective. It is objective for the development of the NGO. It is for the charitable objects, but not for any speculative business. You cannot get the money and you start playing in the stock market. You can't do that. Sorry. Funds committed under prior approval must be received within a period of 3 years. For example, suppose you have got a prior approval. Now it is mandatory for you to see that the money comes within the 3 years from the date of you got the approval. If you receive after 3 years, the approval is not valid at all. So you have to receive within the 3 years. So you should only apply when you are sure of getting the money quickly. Again, that money which you receive should be utilized within the 4-year period from the date of receipt. In case of a delayed, application has to be made for extension. If you feel that, no, I can't spend within 4 years, some problem is there, then you have to apply for extension from the Home Ministry, and Home Ministry may consider your request and give reasons. Registration for foreign contribution. Now, what is the form? Form 3CA. Now, when I said registration, that is after 3 years of existence, you can apply for registration under FCRA to the Home Ministry. The form is Form 3CA. It's an e-form. Form 3CA along with affidavit executed by each office bearer of the NGO. Prior permission of CG in Form 3B. That is when you want to apply for a specific approval, that form is 3B. Such prior permission being obtained for receiving FC more than, however, second and subsequent installment shall be only after utilization of 75% of FC in previous installments. So suppose if you have got one permission for X amount, say 5 crores, and if you have not utilized that money, 75% of that, and you apply for another application, no, you will not get unless you spend 50% of the earlier amount. Now, what is after grant of certificate of registration? You have to open an FCRA bank account. Okay, that is important. File relevant form with central government, certificate of registration on Form 3CA, prior permission. Then upload the signed application and scan documents as specified by the central government. On receipt of this application, they will register and grant COR and give permission within 90 days. That is the law. Within 90 days, they are supposed to either give you permission or reject. They cannot hold it back for long. Validity certificate after they are being issued is valid for 5 years. So within 5 years, you can receive any amount. Now there is no restriction. Once you are registered, there is no restriction on the quantum. You can receive 1 million, 100 million, no issue. But you have to maintain that account. You have to separate them. Prior permission is for specific period. Suppose if it is for 1 year or 6 months, then it is for specific period. Eligibility criteria, as I told you, the firm should register for 3 years. It should be registered under the Indian Trust Act or under the Societies Act, or under the Section 8 of the Companies Act also. It is allowed. Earlier it was Section 13 of the Companies Act, but now it is Section 8 of the Companies Act. Should be in existence for a period of 3 years and has taken reasonable activity in its chosen field. I told you, it should be at least for 3 years in existence. Should have spent at least 10 lakh rupees over the 3 years in activity. That means you cannot have a dormant trust. Suppose no activity in the trust, but when you after 3 years you apply, you will not get it. You should have spent at least 10 lakhs over the last 3 years and in the activity which you are talking about, excluding administrative expenses. Administrative expenses are allowed up to 20% from the what you collect. But as far as the 10 lakh is concerned, it is excluding administrative expenses. And it should have a statement on income. Naturally, a trust will have its account audited under the trust type, so there is no question. Now, eligibility for prior permission, it should be registered society or a trust or a Companies Act, Section 8 company. Submit a specific commitment letter from the donor. I told you there should be a specific commitment letter indicating that the amount and the purpose of foreign contribution. Submit a copy of reasonable project. What for you want this specific approval for the benefit of services contribution is proposed to be utilized. Now, these are all these conditions for grant. Fictitious application has not been made fictitious or benami. That means you cannot have a wrong, bogus trust and you apply for it. Found guilty of diversion of earlier, if there has been any defaults by you or found guilty, you will not get the registration. Engage in propagation of sedition, against the country. Contravene any of the provision of this act. Likely to use FC for personal gains, and if the Home Ministry feels that this trust is going to utilize this money for its personal gains, then it will not give you the prohibited from accepting FC because of the earlier deeds. Prosecuted or convicted for any other offences. And again, that is talking about the disharmony or communal tension. So in those situations, that trust or that NGO will not get. And even if this is applicable even to the trustees or those office bearers of that trust. If they are also found in that, then also they will not get the registration. Applicant has undertaken reasonable activity. I told you 10 lakhs for in the expenditure. But application has prepared a reasonable project for the benefit of the society. If the application is individual, they must not have a conviction under any act and no prosecutions pending against them. If the application is other than individual, none of its director or officers are convicted. That is also very important. Acceptance of FC is not likely to affect the prejudicial election, public interest, etc. How the Home Ministry is going to assess this. Acceptance of FC shall not lead to incitement of an offence, endanger the life of physical safety of any person. Now, as RPG initially mentioned, that so many of the NGO registrations were cancelled. It is because they have violated some of them. As per the instruction of COR may suspend or for a period exceeding 180 days. Once COR is suspended, the person shall not receive FOC during the suspension period. That he cannot. Now they are suspended. Now they cannot get the foreign currency. Person can only use 25% of FC with prior approval. Whatever is already collected, only 25% of that they can utilize with the prior permission of central government, even though they were granted registration when they got the money. But now it is suspended, so now they cannot utilize that money. Only 25% allowed with the prior approval. To be cancelled if the holder made incorrect statement. All that is always there. Violated terms of the conditions, violated provisions of the act, not being engaged in the reasonable activity, chosen field for and the society for 2 years or become defunct. If the trust has become defunct, then there will not be the permission will be cancelled. Cooling period. After cancellation, a person is again if once it is cancelled, you cannot immediately apply. You have to wait for 3 more years after that to get a fresh application. So 3 years you have to wait. Surrender. Suppose you now know you don't want to comply with this FCRA law, and now you don't want to get any foreign contribution, and you have completed your projects. Now you want to go and suo motu surrender. 5 years period is not over, and you want to go and surrender. A person can make an application to central government to surrender the COR in Form FC7. CG will make an inquiry that no contravention, everything they will accept it and cancel the registration. If CG is satisfied, then the surrender, then they will surrender from the date of acceptance of the request. So it is the date when they accept. From that day, you are not required then to comply with the FCRA law. But till the time, yes, you have to comply with the FCRA. Renewal after 5 years, yes, you can renew. To be made within 6 months before the expiry. You don't wait for the expiry date. Suppose if it is 5-year certificate, 4.5 years immediately apply, and you have to pay 5,000 rupees fee along with Form FC3. Then they will renew it for further period of 5 years. And if there is a delay, the delay can be controlled up to 1 year because you have not, after 5 years of completion, you have not applied for renewal. So for up to 1 year, they can delay the confirmation. And after expiry of 5 years, fresh application has to be made. Now they have to intimate to the government amount of each foreign contribution received, even if it is a registered or it is a prior permission. You have to intimate to the Home Ministry in a particular format the what amount received, source and manner of receipt, and purpose and manner of utilization. This is all coming under one form, which form has to be certified by a chartered accountant. As a professional, we are required to certify this form and submit to the Home Ministry. And I would suggest all of us as members should be very, very careful when you are certifying these forms, either under FCRA or FEMA, ODI form for the compliances, or 15CA, 15CB, or this FCRA form certification, or even the APR certification also is required by statutory auditor. You have to follow the principles of auditing standards, my dear friends, because tomorrow if anything is found wrong, then first tack is on the chartered accountant who certified this form. I give an example under FEMA. I'll just quickly, just relate one instance on FEMA. Our client had made an investment outside India under overseas investment, and we had certified that form E of the FC, and the bank then remitted them. So I happened to go to the bank, and then I knew that person. So he just showed me that they are supposed to, after we submit, they are supposed to forward this to the RBI. Now, he showed me the wordings that that person wrote when he sent to the RBI. He says, based on the certification of the statutory auditor, we have permitted this remittance. Now, if you see, the AD bank is the fully authorized and of the RBI. It is the delegated person of the AD bank is the delegated powers of RBI to validate this particular transaction. They know the master direction, they have everything. They know what are the compliances required, but they still want to go by the CS certificate and don't want to take the responsibility on their head. They said now it is, of course, RBI will tomorrow if there is a non-compliance, they will catch not only the chartered accountant but even the AD bank, because they are also supposed to have seen the transaction before it was remitted. But even the company, the chartered accountant, and the bank, all three will be questioned. So we have to be, as a chartered accountant, we should be ready with all our audit files, where how we have certified. I'll give a simple example. I told you about it, FATF compliances under FEMA. When you are remitting money outside India, you cannot remit to a FATF country which is under grey list. Suppose, for example, one country is under grey list on a particular date, and it has been removed. It keeps changing. Okay, and you have downloaded a particular FATF form, let's say on a particular date. On that date, this particular country was not under the FATF list. Fine. So you have downloaded and kept it on your file with a date marked that yes, on this date, the FATF list does not contain this company under the green list. Now, after that particular form which you already certified, or you have not yet certified, you have still just downloaded. Now, there is some time lag for the remittance, so you have waited. And after 15 days, the company says, now you certify and give it to us, we want to remit. Now, within the 15 days, suppose that FATF site is updated and this particular country comes under grey list, and you signed thereafter not checking whether this country has come under the FATF, then you are in big trouble. So when you are signing on that time, you should download again and check whether this country is on the FATF. Download that particular page on that day and keep it so that your signature date and the date should match. Yes, I am done on that day. So these are all the very important basic care we will have to take when we are certifying. Like I told you about the net worth, how it has to be. Similarly, in this case of FCRA, whether the receipts are serially properly numbered, whether the source of the money has come in properly into the bank account, whether the utilization of that thing has happened as per what was the planting, the payments are made correctly, it is not some diversion. All that thing you have to check, and then only you certify that form. Otherwise, don't certify. Or you give up your qualification if at all it is. So you have to comply with your auditing standards, particularly SA 230, which is very important, documentation. What is not documented, that is not done. And that is where it is very critical that the paper should be in the file. So annual return is to be filed after all the money is done, and that is to be signed by a chartered accountant. As I told you, Form FC1 is there. Submit income and expenditure account along with this Form FC1. And there is a foreign contribution relates to currency. Submit annual return in Form FC4. If there is a foreign currency has been received, suppose some foreigner has come and given some donation in foreign currency, dollars mein dekhe, it is not remitted from outside India. That also you can issue a receipt, and it is separately to be submitted in foreign FC4. And this money has to be surrendered immediately to any bank. You can't keep the money in your bank in your drawers. The annual return, I have already told you. Copy of, even if it is nil, you are supposed to submit, certify and submit. Even there are no receipts, no payments, even though there is a bank account, but there is no transaction, submit certifying nil accounts. You have to provide these details of the contribution received on your own website within 15 days at the end of the quarter. So even on your website, the person should know that who has contributed from the foreign source to your NGO. That also has to be provided under this website. If there is a contravention, there is a penalty or jail up to 6 months and fine. No limit. There is no limit of the fine. There is a prosecution of 6 months. Payment of currency received in contravention, again jail up to 3 years. And any FC contravention of the act, jail up to 5 years. Suppose you are not eligible for receiving. I will tell you, many of our members, when they are auditing charitable trust receives donation from outside India by way of inward remittance or from the local accounts. They don't know whether it is a foreign source or no. Suppose, for example, if it's an NRI, no issue, because NRI is not covered as a foreign source. Suppose if there is a foreign citizen, but his name is Indian, it can be one Mr. XYZ who is an Indian, who was an Indian name, but he has got a US passport. Now, you don't check everybody's passports when you are giving somebody giving donations. So you have to, if you feel that yes, this particular person is a foreign citizen, then you should take a declaration whether he is eligible or not eligible, whether he is a non-resident Indian or a OCI. If he is OCI, you cannot accept. But if you are registered under FCRA, yes, you can accept. But if you are not registered under FCRA, then you cannot accept. So you have to be very careful, because if you receive money and tomorrow it is located, then you are in big trouble. Then there is a person who omits an act, currency security, who is possession liable to 5x times the article and 1,000. So this is also there. 5, no separate punishment provided, jail up to 1 year. If there is no specific provision, so this FCRA, if you see, it is more into prosecution compared to that. So I have come to the end of my today's talk. If there are any questions, I'll like to take it up.
Yes, sir. We are getting a few questions. I'm
Yes.
reading out the questions. This is the question from Syed Zia Abbas Rizvi. He has asked whether an OCI who is a British citizen can become a trustee of an NGO while he is resident in India and he does not want to surrender foreign citizenship. Whether such a person can give donation to NGO of whom he is a trustee as mentioned above.
No, he cannot. Because the OCIs are considered as a foreign source, unless if the trust is registered under FCRA and they are eligible to receive this particular contribution. Yes, any OCI, whether it's a trustee or no, can remit money as a contribution to this trust. But if the trust is not registered under FCRA, or they've got no prior approval from the Home Ministry, that trust cannot accept from an OCI. They can only accept from an NRI, non-resident Indian.
Yeah, the next question is from Moksha Tikambet. The question is, what will be the FEMA implications for a professional providing IT services to a person outside India and receiving foreign currency?
Yes, very good. Very interesting question. As I mentioned to you earlier, if it is IT software and ITES, these are to be checked as far as the definition is concerned. If you are IT-enabled services, like you are sitting in India and filing returns of some foreign citizens, or you are doing accounting for foreign citizens, or doing some BPO type operations, so it is an ITES. Or if you are rendering software services or developing software and selling to them, then first and foremost, you are required to be registered with an STPI locally available in your area. In Pune, there is a STPI. In various countries, various cities, there are STPI units. And you have to register with that STPI. There are some fees to be paid. First and foremost, before you, yes, you can render service, but then when you raise an invoice, you have to first submit this invoice to the STPI. They will vet the invoice based on the arm's length price. And once they clear the invoice from that, then you have to submit to the customer and receive the money. Again, then FEMA applies. 9 months you receive the money and all that is there. Then AD Bank comes into picture. Now, another thing, there are quarterly reports to be filed with STPI, and annual report also is to be filed with the STPI. So these are the compliances for an IT company.
So can we go for next question?
Yeah.
It's by Nikki Shah. Sir, under FCRA, if Section 8 company or trust receives FCRA under specific approval,
Yes.
is it allowed to further donate that fund to some local NGO?
No. That what they have received, now see, it is specific approval. The specific approval, they must have given some purpose. That they want to develop some school or college, some hospital or whatever. They must have given some thing that they, for what this contribution they want to receive. They can give the donation only to that. They cannot give it to somebody else. Otherwise it is like, it is indirectly a foreign contribution is going to another trust. Very simple. I told you very, very basic principle. What you cannot do directly cannot be done indirectly. Like, for example, that another trust which is receiving that second donation may not be eligible. It's not registered, is not, but then indirectly it has received a foreign contribution from via another trust. No, that is not permissible. So you cannot do that, and you can only use it for the expenditure what is permissible under what your projection you have done. Before getting the prior approval, you must have given some submission based on that.
Yeah. Some more clarification is
Yeah.
required by
Yeah.
Bharat Jain regarding gift. Limits on gift to NR non-resident relatives and limit on gifts from non-resident relatives. The same A and B.
I
Can
didn't
you
get a question.
specify the question? Limits on gifts to non-resident relatives and from non-resident relatives.
Yeah, okay,
To and
fine.
fro.
Good question. A resident can give gift to a non-resident only to relative is $250,000. Simple. You cannot go beyond that, even if it is your daughter or wife or whoever. As far as the money coming in from outside India is concerned, the limit is not there, but the gift is only to the relative. There is the, of course, when you receive a gift from a non-relative, again, that income tax 56 applies. We respect you either ways.
Okay. So one more question. Continuing of the British national who gave contribution. That person is staying permanently in India after retirement, but he did not surrender British passport due to his family staying in UK. It's in continuation to the question of that British citizen. Who
Very
wants
good
to
question. Here we are talking about citizenship. If he is a citizen of foreign country, then he's a foreign source, irrespective of his residency. Now, again, let me explain you. Under FEMA, the residential status is important. Yes. As far as FCRA is concerned, it is a citizenship that is important. If he's an Indian citizen, irrespective, he can give donation, whether he's a resident or non-resident. Resident, of course, we can collect. There is no harm. But if it is a non-resident Indian also, he can give as much as he wants. FCRA doesn't have. But when there is a foreign citizen coming in, whether it's a resident or non-resident, doesn't. The source doesn't say non-resident OCI, non-resident foreign Indian. It says foreign citizen.
Please. Let me check more questions. Questions. So right now, this much set of questions are there.
Yeah. And if they want any other further questions, they can send me an email or send me messages. I will reply. I have been replying for various FEMA courses, so that's no problem.
I'm checking with some more questions if coming up.
Yeah.
Then we can conclude, sir.
No problem.
No, sir. Okay, can we now, since we have done with the time frame also, we wish to conclude this session. So on behalf of the Committee of Commercial Law, Economic Advisory and NPO Cooperatives of ICI, I would like to extend my vote of thanks. So it's my privilege to extend our heartfelt vote of thanks to our esteemed speaker, Kusai Kuwala, for sharing his time, wisdom, and deep insight with us today. So your session was not only rich in technical content, but also very deeply engaging, captivating. Your clarity on complex topic of FEMA and FCRA and your ability to connect on regulatory frameworks with practical applications truly enrich our understanding. The depth of your experience, spanning over 37 years, was evident in every example and explanations you shared. We are especially grateful for the way you have brought up the topic FEMA with such precision and relevance. Thank you once again for your valuable time and for making this session so impactful. We look forward to many more opportunities to learn from you in future. Thank you, sir.
Thank you very much. Thanks, everybody.